Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Simon Evan Cook, manager of the Premier Multi-Asset Growth and Income Fund. Hi Simon.
Hi there.
So I thought I'd start by asking you the question, are you an optimist or are you a pessimist for 2016? Because people seem to be falling very much into those two polar camps.
Well, I'm glad you qualified it for 2016 because by nature I'm an optimist, but probably at the moment I'm sort of moving towards pessimism a little bit. We're valuation-driven investors, so we'll start with that. And the valuation of most asset classes currently looks unappealing. You would say maybe fair value if you're being kind, but in some ways, in some places, it looks quite expensive. So that's where we'd start. The pessimism starts. I mean, as always, there always are macro troubles brewing. It wouldn't be, it'd be quite scary if there weren't in a way. But the difference is now you don't have that cushion in valuations, and some of the macro scares out there seem quite worrying, quite realistic. Had we had cheap valuations for that, you'd be prepared to take that risk and ride them out. But with not a lot of fat there, it makes us a little bit worried, yeah.
Let's drill down then. When we last met in July 2015, you said that you didn't have any direct exposure to China, although some of the funds that you owned had Asia exposure. Has that changed at all?
Still no direct exposure to China. No, it's the same situation really. We went through. So July we had the August sell-off, and the fund did extremely well during that sell-off. It outperformed the peer group very well. It didn't really seem to dent our relative performance, and we had a great year in 2015 as well. So we did have Asia exposure, but that didn't really seem to hurt because we certainly didn't have a lot of direct China exposure. That felt like us before that to being quite an uncomfortable bubble, and it seems to have turned out that way. Certainly in August last year and the first week of this year, it looks pretty unpleasant to be in. So no, we don't have any direct China exposure.
It's funny because the themes that we discussed last time continue to be the concerns of investors, although in that interim period, of course, markets have gone all over the place. The other thing we discussed was commodities. I mean, this time last year, if you'd said, where can commodities go, people would have said, oh, they halved in 2014. I think they're going to stabilise. And of course, again in 2015, they pretty much halved again. Yes. Looking at 2016, you said last time that you were keeping an eye on commodities and waiting for the right price. Presumably now things are looking more attractive from a value point of view.
They are more attractive. Within this fund, the Growth and Income Fund, we have dabbled in the sense that we have bought a smart materials fund, so not direct commodities exposure. This fund itself invests in materials which are lighter, more efficient, but have been linked to commodity prices because they're substitutes for. So if the price of steel falls, you don't need the substitute so much, so the price of this fell. So we thought that was a good opportunity to buy into that. But what you have got with this fund that you don't necessarily have so much with commodities is that regulatory tailwind that people are going to want to be more efficient. They want to cut down on pollution. So we think that's got some backing that maybe commodities don't. But also further up the risk scale, we run a global growth fund as well, which isn't maybe as conservative as the Growth and Income Fund. And we've taken a very small position in a highly active commodity equity fund in that. We're talking around 1%, so we're not betting the farm. But our theory there is I think there will be some companies that will come out of this okay, providing their balance sheets are strong, providing they're well run. I wouldn't want to buy a market-weighted basket. I wouldn't want to buy a passive exposure at the moment. I think it's a point for picking the bits out of the crisis that might well come out stronger than they went in.
So if China is still a concern and commodities is not quite there yet, where are you finding opportunities?
Well, something we've done within the Growth and Income Fund, we put a position in December, is we've been adding long-short equity funds in there. So not quite market neutral, but getting towards that. So what we've done is we've taken out a lot of beta. Now, this isn't us trying to call markets. The way we view markets is that we try and work out over, let's say, the next 7 years, what could you realistically expect from an equity portfolio. We think that's low currently because of valuation. So maybe you should be expecting, if you do well, 6% a year from here. Now, that might be 6% a year literally, or it might be 6% with a big drop and then a higher return from that. We don't know what the path looks like. So if it's only 6%, there's not an opportunity cost of putting in a long short fund which takes the beta out. We think we can make maybe 6% from these funds too, but without the market volatility along the way. So at this point in the cycle, that feels like quite a sensible move to us. I mean, we put in a basket, so we've reduced manager risk, and again, we're talking maybe 5 or 6% of the fund. It's not a giant macro move because we don't tend to make those moves.
Simon, thank you very much.
My pleasure. Thank you.
This is Emma Wall from Morningstar. Thank you for watching.